By now you're probably thinking, when is he going to get to the part where he tells us how to actually figure out the production cost? You probably already knew I was going to say this, but I can't just tell you how to figure it out. That's going to depend on a number of factors, depending on where you are and who you're working with. An ideal way would be to actually sit down with the producer, figure out what exactly they're spending money on and how much coffee they're making. I do this periodically among collective members in different regions of Colombia with producers that have different growing and processing practices in order to have an idea, because if you've ever gotten one of our transparency reports, it includes the production costs, and that's how we figure that out. If you don't have the luxury of being able to sit down with the actual farmer, there are a number of secondary resources out there. If it's a country that has some sort of a coffee authority, they're most likely going to have at least some literature published, maybe not super visible, but you can probably get an idea. Asking around with industry actors, co-ops and farmer groups are going to have an idea of these numbers. And of course, it's going to depend on each farm, depending on how they're running their operation and the farm size. If you don't know the farm size, you can probably get a pretty close average estimate from whoever you're working with in supply chain. Or if you're working with a single farm or a small group of farms, you can, again, depending on the folks you're working with in the supply chain, you can probably get a pretty accurate number. Hello everyone, I'm Karl from Cedar Alto. Welcome to our next episode of Coffee Economics with Karl. We're still talking about cost of production. As usual, we got into a topic, started discussing it, and by the end of the video I realized there's so much more that needs to be covered before we move on to the next thing. So we're going to take another episode here to dig a little bit further into production costs, this time focusing on farm efficiency and productivity. So aside from the fixed and variable costs that are going into producing coffee that farmers are going to be incurring, we're going to take a closer look at how certain fundamental decisions about how farming is taking place is going to affect production costs. We have a lot to cover in this one, so let's jump right in. Last video we briefly mentioned the idea of efficiency and how that's going to vary between every farm. Basically how much time and effort it takes to produce one unit of coffee on one farm versus another. As we mentioned, each farm, each harvest, maybe each day is going to have a slightly different production cost. So if someone is sourcing coffee, they want to know the production cost to be able to understand the farmer profit to make sure that farmers are earning enough to sustain themselves. The actual farmer's production cost is a good place to start. But we need to give some context to this based on the average production costs for similar processes taking place in the same area. If one farmer is spending $1,000,000 to create a carga of dry parchment or $2.50 per pound of green coffee, and their neighbors are spending only half of that to create the same product, we have a problem. As mentioned in the last video, we don't want to be subsidizing inefficiency. So it's important to know how these costs stack up compared to a reasonably efficient operation. So how the cost of production of one farm compares to a large sample of similar farms doing similar things in the same area with similar conditions is going to be a measure of the efficiency of that individual farm. That isn't to say that each farm's production cost should be equivalent to or less than the average production cost in that area, because this has a lot to do with decisions being made by each producer that have a significant effect on the product that they're creating. However, any additional cost that's being incurred should be intentional in order to create additional value or add additional value to the product that they're making. So if we do come across a farm whose production cost is significantly higher than other similar farms in the area, that's not necessarily inefficiency, but we need to know why. For example, they might be sorting cherry for color, which would imply a much higher cost of labor because someone has to stand there and do that. This is a decision that could be made by a producer in order to create higher quality. But is this practice actually leading to comparably higher quality? And is that higher quality worth more than the additional cost incurred in creating it? If yes, then that's a reasonable, logical decision. If no, then we could consider that inefficiency. Let's take a quick look at the difference between fixed and variable costs in coffee farming. If, for example, a fixed cost would be a cost per area, that doesn't necessarily imply a certain amount of output. Now, if we take that cost per area and divide it by the yield per area, we get a cost per kilo. We get a cost per unit. In this case, let's call this a kilo of output of whatever product it may be, green coffee, parchment coffee, cherry. It doesn't matter for the sake of the example. If this is the case, a higher yield would distribute this cost per area over more units of output, and therefore the cost per unit or kilo of output would be lower. This sounds simple, but where it gets tricky is what costs are incurred in order to increase the output per unit of area in order to distribute those fixed costs over more units of output. We'll get into this in a minute here. To visualize this idea, let's do a really quick little graph here. Total cost, so zero cost, higher cost versus production. So zero production, higher production. In this case, this is a fixed cost, so it doesn't matter how much is produced. It's one cost that's incurred and likely before there's any output, and it doesn't change based on how much output there is. Moving on here, let's take a look at variable costs. These are simply costs incurred per unit of output. Picking would be an example. You pay somebody to pick a kilo of cherries, you have a kilo of cherry. You don't pay anyone unless they bring in that kilo of cherries. If this is the case, if yield per unit of area increase, the cost per unit of output remains the same. You harvest 5,000 kilos of cherry, you pay picking for 5,000 kilos of cherry. You harvest 10,000 kilos of cherry, you pay for 10,000 kilos of harvesting. Another quick little graph here. Total cost by units of production. Zero production, zero cost. Production rises, costs correspond. You notice these lines are straight. Again, really simple examples just to review what a fixed and variable cost is. In most cases, in reality, these will not be straight, which is exactly what we're going to see right now. In the second half here, we're going to talk about optimizing farm decision making in order to maximize profit. In coffee farming, in a lot of cases, we're going to see diminishing returns on investment. And that concept really basically is you invest one input, you get one corresponding output up to a certain point. When returns begin to diminish, output or profitability or whatever will be less than before for the same amount of input. So you have one input, you get one output. At a certain point, you invest one input, you're going to get one half of an output. If returns diminish further, you're going to invest one input, you're going to get 1/4 of an output until the point where you just keep inputting and you don't get anything out at all. Let's take a coffee example of what I mean by that. Taking a look at this chart here, let's say this vertical axis here is production cost per kilo. What does it cost to make 1 kilo of coffee? And on the other axis here, this is yield. So how many kilos are being produced per hectare of land? Also, let's say this is 1 and 0 is not shown here, just so this makes sense. So you can produce a little bit of coffee without doing really anything at all to the land. Zero fertilization, zero pruning, zero tree renovation, zero pest control, zero weeding. There will be a little bit of coffee, and it will cost you almost nothing to produce it. The only cost of actual production will be the manual labor of picking and bringing in the cherries, and then of course all the costs of processing. So at an extremely low yield per area, your total cost of production per kilo will be also extremely low. You start investing a little bit more in the land in order to increase yield. You can invest a bit, your yield will increase. At a certain point, you'll have to start investing even more to get your land to produce more coffee. So your cost of production per kilo will increase. Then you get to a certain point in which, in order to increase yield further, you'll have to invest quite a lot more in order to increase output by a little. And this is when this curve starts to get more steep and returns diminish. So let's say our other y-axis here is the sale price per kilo. Just for example, let's say this is $3. That's going to be right here. So where these two intersect, this is your break even. So any more coffee you decide to produce after this point, it will be at a loss, because the cost of producing those additional kilos of coffee will be much higher than the kilos produced up until a certain point. So the first few kilos you produce without doing basically anything to the land, your profit margin is quite significant here. And as you decide to produce more kilos from the same amount of land, your profit margin shrinks up until it becomes negative. So this entire area in here is profit. But that doesn't mean that you should produce right up until the break-even point, because this whole area right here is just barely profitable and possibly not even worth your time, which we'll see in the next graph. In this second graph here, we're going to look at total profit per hectare. As I mentioned, we're not going to keep on producing up until the point where it becomes unprofitable. We're looking for the perfect amount of investment in the land that creates the amount of output which will generate the most profit for the farm. The x-axis again is kilos of output per hectare of land. And the second y-axis here in red is profit per kilo. The red curve here, profit per kilo, is going to look like an upside down version of our cost of production curve based on diminishing returns. So the first kilos that you're making without doing basically anything to the land are going to be the cheapest to make, and given one constant sale price are going to be the most profitable then. But they're going to be very, very few. So profit is quite high, it starts to fall a little, and then it starts to fall a lot more until this break-even point where it becomes negative. Now this is not a straight line, but let's just say this point is directly below this point here, if I were a better graph drawer. Even though these first very few kilos that we're producing without doing anything to the farm basically are the most profitable, the subsequent kilos that we can produce to the same land are also going to be profitable. So it makes sense to do it, but not all the way up to the point where they become unprofitable. So let's draw an estimated curve to show the profit maximizing yield. So here our profit would rise very fast because we're investing very little to create more coffee. So our profit would rise very steeply related to the total production per hectare because these kilos that we're producing are requiring very little inputs, very little effort, and therefore are quite profitable. So we will see our profitability rise with an increase in yield very sharply up until a given point where the total profitability of the farm will begin to fall all the way down to zero. Again, exactly where these points are going to be and what numbers are going to be on these axes are going to depend on each situation of each individual farm. So the idea is not to invest and invest and invest in our land in order to create output up until the point where the farm is just barely or not even profitable, which is a point that will exist at some level of investment. The objective of a producer would be to figure out where exactly is this perfect point where their cost of production is reasonable and their yield per hectare is reasonable in generating the highest level of profitability for that farm. Tying back into farm efficiency that we saw before, this is pretty much where a lot of farms are going to get it wrong. They could be somewhere around here where their per kilo profitability is quite high and their farm is quite inefficient because they're not spending almost any money on it, but the profit derived from that small number of kilos is not enough for the family to live on. And more likely, due to the influence of input and machinery, salespeople, and in some cases, different sector actors that are interested in incentivizing total production above all else, productivity could actually be too high to be profitable for the producer. The more production is taking place and the higher the cost of production, the closer the farmer gets to this break-even point. And because, as we know, the sale price is in no way fixed, it's always fluctuating, a farmer that has let production costs get too high in search of higher and higher yields is going to be more vulnerable to price fluctuations and at higher risk of having to sell at a loss than other producers who have not invested as significantly in increasing yields and have held their production costs per unit of output lower. With the Cedro Alto group, we're 100% small-scale subsistence farmers, almost all of which operate on a very tight cash flow structure and are not able to endure harvest having to sell out a loss because price was down and absorb that loss, waiting for a subsequent harvest with a higher price in order to really take advantage of it because of their high yields. So the way the majority of them operate their farms is at a bit lower yield but a much lower cost of production per kilo. And this is what I recommend to these producers with that risk profile in the majority of cases. So in summary, cost of production is what it is. It's important to know the cost of production of the actual farm that you're working with, but it's also important to understand how that stacks up against the average cost of production, making sure that additional costs being incurred at the farm level correspond to additional value so as not to incentivize inefficiency. And then all this about fixed and variable costs and the ideal investment in yield in order to maximize profitability is just kind of food for thought if you're not dealing with producers directly. But this has a lot to do with why production cost is going to be so vastly different among producers. So that was video 2 on coffee production costs. There's going to be one more next week on producer profit, as promised in the previous video, in which we'll look at farmer profitability and family cost structure. So stay tuned for that one. Thanks again for watching. As always, if this has brought up any additional questions or you need further clarification on anything mentioned here, please leave them in the comments and I'll either answer you there or we'll work on another video in the future to answer them. If you found this information useful or interesting, please consider subscribing. Thank you.